markets in August gave back some of the gains made in July, mainly due to increased risk aversion as investors moved money out of equities in favour of bonds, and this is down to concerns about the US economy. So bonds became very popular during the month, particularly those issued by governments regarded as safe, such as Germany and the US. So AAA rated government bond yields fell to historically low levels. In fact, the German 10-year government bond yield came in at just 2.12% at the end of the month, a level not yet seen. There is a number of factors driving bond yields to the levels they're currently at. One is really the fact that there has been increased demand over the last number of months for bonds due to increased risks to the economic recovery. Also, more recently, legislation has been passed requiring banks and pension funds to hold safer asset classes such as bonds within their portfolios and structures, and this is clearly driving demand for bonds. And it's also, I suppose, driving the spread between the core bonds and the peripheral bonds. I suppose also what's happening is the fears of a double-dip recession are pushing investors towards safer asset classes such as bonds. And although the double-dip recession doesn't form our base case scenario, it is a pertinent factor. It's clear that a lot of the data coming through from the US more recently has been weaker than expected, but having said that, it is still very much in expansionary territory, in other words, above the 50 number. The main risks weighing on sentiment at the moment is the consumer data coming through, and this is largely down to unemployment. So while there are risks out there, the double-dip recession doesn't form part of our base case scenario. We're more comfortable with the level of equity markets now than we would have been at the beginning of August. We do expect volatility for the rest of the year given the fiscal austerity measures that are being implemented and the lacklustre economic growth that will be linked clearly to that. We see probably increased risk to earnings numbers for 2011, but we're very comfortable with the earnings numbers as they are for 2010. We probably see valuations as quite compelling at the moment. We don't see valuations as something that drives markets forward or as a catalyst to drive markets forward. We would see earnings and economic growth more as the catalyst in that respect. However, we do feel that valuation levels are compelling at the moment.